All right, you want to start?
Okay, so I was just gonna go into, is it okay? You want me to
That
start
wasn't
with
even
you
a
guys
start.
want
That wasn't a
Yeah,
start.
let's do it.
Okay, all right, so I was just gonna start off with how we got here, right? So back in 1929, there was a stock market crash, and that triggered the Great Depression. So it wiped out a generation of investors. So from that point on, they were like, we have to do something because this can't ever happen again. So in 1933, the Securities Act was formed. And so it was passed by Congress. It required companies selling investments to register them. It required truthful disclosure to investors and full disclosure at the point of sale. So then in 1934, the Securities Exchange Act passed. That was 1 year later. So it created the SEC, the Securities Exchange Act Commission. It regulated the secondary market. So the first one, the 1933, regulates the first, the IPO, the initial launch of tokens, not tokens, because that's an ICO, the IPO. And then the second, the 1934 Act, the SEC monitors the second listing. So it's two different, you know, um, two different launches, right? So IPO and then the secondary market. So then in 1946, there was a lawsuit, and it was the SEC versus W.H. Howey Company. And so essentially, it was a Supreme Court case. The case was about a Florida orange grove. It wasn't even about stocks. So the W.H. Howey Company was selling plots of orange groves to investors. They listed the plots, and then they harvested the trees, and then the Supreme Court ruled that the arrangement was considered a security. So the Howey Law was passed. So the Howey Law is the way that they test, is it a security or is it a commodity, is if it passes all four of these things from the Howey. So investment to make money, and a common enterprise with an exception or expectation of profit and derived from the efforts of others. So those are the four things that has to pass in order for it to be considered a security. So obviously, rules from 1933 do not apply to what we need now for blockchain and
Right.
different frameworks.
Yeah.
So this is essentially where all this new stuff is coming from, right? So yeah. And so what happened with the House had passed six things, right? So there were six titles in the House. Let me just find that. So the definitions, the SEC powers, the CFT. Okay, so that's the other problem right now, right? Is like, who monitors what? We have the CTFC who wants to monitor everything and make rules and laws. And then we have the SEC doing the same exact thing. So they're completely overlapping and intermingling. So we need clarity on who is going to oversee what, right? We clearly want the CFTC, but yeah. So then you have the illicit finance, the banking, and the innovations. That was the first that passed the House. So then the Senate bill came in, and they're like, okay, we're going to do some markups to your six that I just said, and then we're going to add three more. So they added, let's see, DeFi protections, stronger illicit finances, and bankruptcy safeguards. So now there's 9 things that the SEC is trying to pass. Not the SEC. I'm sorry, guys. That the Senate is trying to pass. So that's kind of where we are now. They've worked out these things, and that's what they're talking about or possibly signing tomorrow. Yeah. So I just wanted to do a quick kind of rundown of like why we're here, where we came from, and where we're going, which I think, yeah.
What are you
Okay, so
thinking?
you did say one thing, and I was a listener last night on a conversation really what we're talking about tonight. And it was good. Different points of view, but still nonetheless fantastic. I think different points of view are needed in this space. Now, in saying that, they did bring up something which you just said. Why are we so against being part of the SEC, right? Like, why do we feel like we have to have commodities? I mean, people have been making great money in the stock market for a very long time, right? You don't always have to trade oil and gold. You can trade Tesla or Google or whatever the case might be. And so I don't know why I don't know why I even gave those two
Why
examples,
we
but
care about whether it's the SEC or why we
why we're
care if
so
it's a,
hung up.
why do we care if it's a commodity or a security? Sure. So securities are very regulated very differently than commodities, right? So they're very different in
Hmm.
general. Like
Hmm.
how they're structured. Usually it's a company. And so here's the other big part of this. And the biggest part for us as crypto holders is securities are not decentralized. That's the key thing for crypto to be not deemed or not pass the Howey test is it centralized? So these assets that have been deemed commodities have the decentralized green light. They are not controlled by a single entity. So anybody who wants to say that any of the 16 assets that were deemed a commodity are not truly decentralized are very, very wrong, because that is exactly how they tell whether these assets are or
But that wasn't my question.
I'm sorry, what was your
I agree
question?
with what you just said. My question though was, why are we so afraid of the term security? Why people have been making generational wealth for decades on
So
the stock
is
market.
for me personally, and I'm
Hmm.
this is all on me. It's because of how they can be integrated in the system, in the new financial system specifically, whether they're a commodity or a security. I can almost guarantee you that I will have assets that are deemed securities. But for me, and my forward thinking and my forward vision, I have aligned myself with a certain set of commodities that are going to power the new financial system that can't really be a security and have that regulated aspect to it. So,
Okay. Great statement. However, I know there's going to be a lot of people there that people don't understand what you're saying. When you say, and we probably shouldn't even go in this deep, but it's important for people before we go into all of this, right? When you say powering the new financial system, what does that mean to both of you guys?
it means
You started, so go first.
sure. So for me, it means so we're upgrading, right? We're going into a totally new phase of things. And in this phase, we want this new system to run effortlessly in a decentralized way. And that means this system should be able to run itself without a entity powering it, right? Like we can talk all day about, so it's truly decentralized. So if a node goes down somewhere in Switzerland, is it going to crash the system, or is it going to fix itself and come back online and start running again without somebody rebooting it, a human entity, or you know truly decentralized? That's decentralized to me. So, yeah. Does that make sense?
Man, this is probably a whole different show, and but I, I yeah, that's probably yes, to a degree, it makes sense to me.
Right. So, in my mind,
I would being that person that I am, I would say that I would argue that decentralization is a myth.
to some extent, it is. I mean, is anything truly decentralized
That's what I
without
mean.
it will be, but you know, we can get into the decentralized argument
Hmm.
and probably be here for a few days.
That's why I said it's probably
Yeah.
a different show.
Yeah.
Bully, for you,
What was the question?
the question was, what is the modern day? Sorry, that this is a reboot for the new financial system. What does that mean to you? I kind of paraphrased it, but that's what she said, more or less.
So we're currently operating on a financial system that hasn't been upgraded in the last 50 years. Inevitably, we have tech stacks and assets that don't necessarily fit into the way that they've kind of categorized or scrutinized particular assets in the past. So now that we finally have attention for regulations to address this new tech stack for this new digital world that we are entering into, that is inevitably going to open the door to, I want to say, the expectation of today's age. Everything is based on time and convenience and efficiency, and everything has been digitalized in our entire world except for our financial system. So when we say that we are moving into this new financial system, it is kind of just the catch up of the way that our money is going to move at the same way that information was able to modernize. Now, inevitably, all of us kind of watching and educating on this platform and other platforms, we do believe that the enablement of that new financial system per se is going to partake with blockchain and DLT technology. There's going to be other tech stacks that inevitably do kind of evolve into what is our current financial system, but it is that finally we are finally shedding some skin and moving into the digital era.
So this is also another part of that same next show we can do. But I will pose just a question, hypothetically speaking. I agree with both of you guys fundamentally. I think what we are all concerned of, so for the people who believe this, or the people who think they do see it coming but aren't quite sure what that's going to look like, I think the number one question that are on all of the tip of our tongues: does that make us money? Does that make us money? Will these projects? Will these? Because in a speculative market, anything goes, right? Things go up, things go down based on narratives, based on liquidity, based on whatever the case might be. On the new structure, I think the one thing that we're all kind of like biting our breath is, yeah, we see the technology, yeah, we see the moves being made by the sometimes companies behind them. Will that translate to financial gains on our end? And I think that's what we're all kind of waiting for. Um,
Can I touch on that for a second?
Absolutely.
I think that's a really great point, because if, say, so we're in this phase of like, we're investing into utility. Do we even really understand this? Like, we have no clue, right? But like, say we're going to invest into the company Ripple. There was an IPO launch. We invested in the company. We know that based on their performance, we are going to earn gains, right? So like there is, you're absolutely right. Do we even know? Because it stops being, right now it's retail driven and hype driven, right? So like, good news, people buy, they FOMO in; bad news, people sell, they get FUDed out.
Yep.
So that's what drives the price. So the question is, are we going to break off from this bull structure, decouple from Bitcoin, and are we going to move into this utility cycle? Because that's actually what matters. Like you just said, that's what's going to make us money, dividends, however you want to, word it. I don't know if dividend is a right word, but you know what I'm saying. If you're comparing it to a company and how you earn from a company opposed to how you earn from utility, we're hoping that if the company does well, you're going to earn from that. But no, that's a great point, and we don't know.
But you know what is amazing is that it was addressed in this bill. And you can find it in the means of the definitions as they kind of go through it. Ancillary asset is a big aspect to that. And then we'll obviously, when we go through it, we'll explain what this all means. And then it goes into a network token. So that whole idea of moving out of speculation into a utility-driven, that thesis is quite literally confirmed here. Now, they also address in this proposal that the way that they also will classify these assets is whether or not the price is dependent upon an organization or the team's effort, you know what I'm saying? Or whether or not the token or the asset is going to appreciate in price due to the usage and solutions that it solves. So that's also what they're looking at. Is they're looking at, okay, is this the team's effort that's driving the price of the asset, or is it actually technology that's being utilized? And they do address it into this, which is really exciting.
And
Sounds like
Willie, sorry, I'm so sorry. Now, could that be part of deeming a security and a commodity, what you just touched on?
I believe it does.
Yeah.
I believe it does. And there's a lot that inevitably, like, and here's kind of, and I'm going to be a little, I'm going to be like a little counterintuitive here, but even though we have clarity on those, what did you say? It was 9 or 12 assets
16.
that are deemed digital commodity. Technically, as it stands, they are currently going to be listed as an ancillary asset. They are. And these ancillary assets can inevitably be solidified as commodities, as digital commodities in the future. But they state in this bill, in this legislation, that you are guilty until you are guilty until proven innocent. So you have to prove to us that you are a digital commodity. And then they even talk about certification in here as well. And that'll come at a later date. But this is quite literally a guilty until proven innocent type of legislation for all crypto assets. And it kind of proves to us that they will be looking at these assets on a individual case-by-case basis.
Speaking of guilty, there's one thing I did forget. Last year, total scams, protocol exploits, hacks was 17 billion plus on DeFi.
That, my friends, is probably going to come to a halt with all of this stuff. Because I don't know, I'm sure you guys have heard me preach it at least once or twice. There's a whole section on here on, KYCing and AML and all of that type of stuff, which is the whitelisting part of this whole stuff. So it's coming. The wild, wild
we keep
west.
talking around it. Want to get into it? Into the meat and potatoes? We'll put up our.
I love it.
Do it. Let's get into it.
We would. Do you want to kind of pick the bone at any of these slides to give us somewhat of an overview before we kind of go in there with a fork and knife?
So I don't think. I'm totally okay with you guys just kind of going in. I just wanted to, kind of break it down, or at least structure it in a way that we could maybe move through it more fluidly. But so I kind of touched on some of this stuff. So which slide are you on? This one here. Yeah, so the 6, do you guys want to get into the 6 provisions?
Let's do it.
Run with it.
All right.
Let's assume that nobody is going to read this bill because you guys all have better things to do in your life. And that if it wasn't for us, they would never know anything. I think that's how we should take this and read whatever you think is relevant.
You know what? Maybe before we do dive into the provisions, can I start us off with the definitions and how they're establishing the foundation as to what is a smart contract, what is a network token? Because they define it in kind of like a way a lawyer would. And that's going to affect whether or not these assets fit into the description or the definition of what they are telling you a smart contract is, what they are telling you decentralization is. Is that okay? Could I start there?
Yeah, absolutely.
Okay. So the first definition is decentralized governance system. And I have a note here, and it says decentralization is becoming a legal standard for that determines how networks are treated. That is essentially what it is, right? The term decentralized governance means with respect to a distributed ledger system, permitting persons to form consensus or reach agreement in development, publication, maintenance, or administration of the distributed ledger technologies, in which participation is not limited to or under the control of any one person or group of persons under common control. I think we all can agree to that definition, right? That's essentially what decentralization is. It's not down to one entity or one person, right? So this is important that they define this, because now the regulators are sitting there and they're saying, well, who is actually running the network, right? This is something that they want to pay attention to, because a lot of projects can say that they are decentralized, but if you have one company that's still controlling the development, or one group that is in control of the governance, then that is essentially going to create a red flag for people that are kind of claiming that they are decentralized. And I think that holding these ecosystems accountable for when they do claim that they are decentralized is really important, because now it's becoming a legal framework. And I think for all of us, right, when we sit here and we talk to people about governance or dependency on the founding teams and whether a network can survive, right? This is kind of the section that's going to take a look at all of that, and they're viewing it with the same perspective as we do, right? A strong network can still operate without a central entity kind of controlling everything about it. And I think that that's going to apply to projects like HBAR, like XLM, like XDC, like XRP, right? All these infrastructure-focused ecosystems. This is eventually what's going to separate these networks, where they're going to have to prove that they can function as systems, not as a company selling you a technology.
Mm-hmm. Agreed.
You guys have anything to add to it?
No.
Distributed ledger technology. The government is no longer asking if distributed ledger technologies exist, but they're building laws around how to integrate it into the system. So they're basically defining what blockchain technology is here, and it ties into the crypto, right? This is the way that they're stringing together information to ensure that these transactions can no longer be altered. This is your Bitcoin. This is an overall thing, right? This is pretty much everything that we're investing into: Bitcoin, Ethereum, XRP, and now they're focusing on frameworks around the actual technology around it. So this is going to kind of dictate what survives in this, right? Because we have investments that are not blockchains, right? Some of them are not blockchains, but they can be counted as distributed ledger technologies. But it's important that the government is officially recognizing the actual technology itself. Smart contracts, right? The government is now including programmable finance, and they're defining it of how it's going to fit inside of the system legally. And this is the exact, and they pretty much use the exact definition that we've always said, right? It's stored on a distributed ledger technology. It's automatically going to execute once certain predetermined conditions are met, right? And it's important that the people that were participating to the actual writing of this were able to define it in a way that kind of included programmable finance, right? Because if they're not even discussing programmability in this bill, then you're leaving out a lot of Web3 infrastructure, right? So the technology itself is actually being written into law, right? Programmable finance as well. Now, this one is kind of going to throw people for a spin. Ancillary asset, okay? Ancillary asset means that the token is still tied to the team's efforts, not from its utility. And this is where we get that this is the separation of utility versus speculation. So essentially, you could find projects out there where they are going to be kind of put into a box of how they're going to define it based on whether or not the asset or the price of the asset is coming from the team's efforts, or is it actually coming from this technology being utilized as a software? And a lot of the ecosystems that we do invest in, that value, the token's value, is still coming from the builders and the founders in the actual company, right? But the regulators are coming in and they're saying that, is the token actually valuable because people are using the network, or is it only valuable because the investors are relying on the team to create value? And that's the distinction of whether or not this is real technology, or are we kind of investing? I don't want to say like a security, like you're like hoping that the company is going to do right and they're going to create value in that ecosystem. I don't want to say that that it's a security, but if the regulators may view it that way, right? Because if that value is tied to the to the promises or the effort of the team, then the regulators may kind of put that into a security benefit to that. But this is proving that the real networks have to be able to survive and stand on their own without relying on hype or retail narratives or the company driving it. And ultimately, the ones that are going to get that golden digital commodity classification are going to be the networks that can actually deliver a real-world service based on the software or the tech stack that they're delivering. And then we go into network token. Ooh, what happened there? So a network token gets its value from people using the system. The system is not just people believing in the team or the company behind it. So again, regulators are defining what real utility is, right? The token's value is going to come from people actually using the network, whether it's network activity or transactions or applications and services. They're creating the distinction between whether or not something is coming from retail hype or promises, and something that is actually coming from people using the tech stack as it is being kind of what it was promised to develop. And if a token is going to qualify under this network, right? If they're going to classify it as a network token, then it has to have real utility. It has to solve a real problem. The value is going to come from people utilizing the network, and it's going to be treated more like a commodity instead of a security. So it's all tying into one another. And yeah, right here, a network token shall be treated as a non-security, right? What did I mark here? The real goal is building a network strong enough to eventually be treated as a non-security. That's the goal, I think, of any ecosystem out there. And okay, so this is kind of where they're really paying attention to these network tokens being treated as a non-security, right? So if the token is going to truly qualify as a network token under this framework, then it's not going to be treated as a security. And that's massive news, right? Because for years, we're sitting here wondering, is this ecosystem, right? Is this token a security or is it not? But this is kind of creating a pathway where that token can qualify as a digital commodity or a network token and not be treated as a security. But they still have to prove it. So this is what I was saying is, like, you're guilty until proven innocent. You still have to prove that your value is going to come from people utilizing the network, that your ecosystem is being utilized instead of selling people on hype, right? And look at projects like XRP, XLM, HBAR, right? All of that is going to be able to operate much easier in this financial system if they can clear this type of framework. Now that ability where they can actually look at it and they can have that you're guilty until proven innocent. That's kind of where you're going to be able to have some of these assets participate in the financial system, whether it's ETFs or the like custody for some of these institutional clients. Just it's basically enabling that broader financial integration. I'm sorry if this is a little hitting you guys over the head with these definitions.
I mean, just for real world, like, there's a guy right now currently in jail, a samurai. If the law was in place right now, a wife and a husband would not be separated. So
What had happened?
Yeah, he's serving. Yeah, I saw that on you posted that, right?
yeah, I think I did. Yeah, yeah.
What had happened?
Um, he's in jail right now, serving a sentence because of the laws the way they were, guilty until proven innocent. This we're going off on a tangent here, but the whole thing is like he's just a dev, um, you know, and he got slapped with a sentence because they didn't have money transmitter licenses,
Oh,
and yeah,
and that bill addresses this as well.
correct. I know.
It does.
Keep going. Sorry.
So this is where we get into the certification of these assets, right? So the goal is for the network itself to become bigger than the company that created it, and this is kind of where you have to prove that you have to prove whether or not your network can operate independently from the company, or if your token has real utility. So you can no longer in the white papers just say, yeah, we're decentralized, or we have real utility, or we're AI. You actually have to prove it. And under this type of strict framework, this is where we will separate from the narratives of investors, and people can actually start asking, well, if this technology does get integrated in, can I be able to verifiably track that this asset is being used for what they are telling me? And when we say 90% of crypto is probably going away, good. This is what's going to expose the lies of the white papers or the misleading or the narratives in crypto, everything that we're kind of exposed to. This is essentially what's going to create that survivability on the projects if they are actually being used if by their entities that they are saying that they are, right? This is them certifying that they are creating infrastructure. And I think that might be it for the definitions, right? And then I start to getting into examples for certain transactions, but I wanted to have a clear basis of the way that they are defining these crypto assets and how they're perceiving them, and how they are actually going to be testing whether or not these assets are securities, are they commodities, and basically it's just accountability, right? This is ultimately what regulations is kind of bringing into the space, is that ability to certify the ones that are actually doing what they're saying that they're doing, and separating from the ones that are kind of getting you in on the project based on your emotions.
All right, you want to go on to section one, title one?
Hit it.
We will.
What exactly are you looking at here? You're looking at the slideshow for the provisions, or are you going into the Clarity Act?
I I would play for everybody else. I would play the slides, and then can do the.
So this is where you're looking at, right? The jurisdictional split.
Correct.
Okay.
Although we lost, we will. Okay, so what we're gonna do, guys, is we're gonna read. We're literally gonna tell you a bedtime story. It's gonna be 9 sections long. They're called titles. We'll go through each one. We'll talk about it as we go. Um, I am trying to get my place. The title. Title
Sorry,
one
guys.
is. Oh, she's back. Good.
I'm sorry. I had a
Would you
little
like
one
to?
who needed.
Oh no, absolutely. Mom first. Um, would you like to read the title one?
Title one. Sorry, guys. Let me get to my.
It's page 10,
Do you want to go
actually.
with it? Are you ready to do that? I feel like I'm
Uh,
discombobulated right now.
why not? Let's do it. Um, okay, so like I said, we're here tonight to talk about. Thanks, B. We're here tonight to talk about the Clarity Act, so that's why we're here. If you guys want to drop in and out, feel free. It's gonna be a bit of a haul, but we're doing this for everyone so you guys can now know what people are talking about. There's going to be a couple sections that are going to really push some people's buttons. There's going to be some things that are going to be like, meh. Um, Nonetheless, all important since this is the space that we're in and investing in. So
And this
Title
is
One
a
responsible.
309-page bill. This is a 309-page bill. Most people are not reading this.
No. We are going to skip over the housing section. We can talk about it, but there's no real reason to talk about that. Title One, Responsible Securities Innovation, Section 101. This may be cited as the Loomis-Gillibrand Responsible Financial Innovation Act of 2026. Disclosure requirements are for certain transactions involving ancillary assets. In general, the Security Act of 1933 is amended by inserting after section the following. Section 4B, requirements with respect to certain transactions involving ancillary assets. Definitions, we just talked about that, so I'll skip it. Ancillary asset originator. In general, the term ancillary asset originator means with respect to a particular ancillary asset, a person that whether directly or through one or more subsidiaries or controlled entities initially offers, sells, or distributes the ancillary asset during the 12-month period beginning on the date which the ancillary asset is initially offered, sold, or distributed, controls or causes the initial offer, sale, or distribution of that ancillary asset. Joint and several liability. For the purpose of this paragraph, if the person that initially offered, sold, or distributed an ancillary asset or otherwise sold or distributed, controlled, or caused the initial offer, sale, or distribution of the ancillary asset, did not receive the largest amount of the ancillary assets distributed in the 12-month period following the commencement of the offer, sale, or distribution, then that person solely for purposes of subsection 6C shall be jointly and severally considered to be an ancillary asset originator with respect to the ancillary asset. That person, the person that controls such offer, sale, or along with the person or persons under direct or indirect control of that receive the largest amount of the ancillary assets in that period other than the ancillary assets received. So number 10 says, in an intermediary capacity, or two, solely through gratuitous distribution, or through an offer, sale, or distribution of a security to the public registered under Section 5. Otherwise, in a broad and public manner that the Commission determines pursuant to regulation should not subject the person to disclosure requirements under the subsection D. Rulemaking. Not later than 360 days after the date of enactment of this section, the Commission shall, after providing notice and the opportunity for comment, issue rules regarding the circumstances under which persons that are jointly and severally considered an ancillary asset originator pursuant to subparagraph B are responsible for furnishing the disclosures required under subsections on behalf of the ancillary asset originator. Certification covered party. The term certification covered party means an ancillary asset originator, a subsidiary of the ancillary asset originator, or C, a related person of the ancillary asset originator, or D, an entity that directly or indirectly controls or is controlled by a common entity with the ancillary asset originator. 4, a decentralized governance system, digital asset intermediary. Related person. The terms decentralized governance system, digital asset intermediary, and related person have the meanings given those terms in Section 2 of the Digital Asset Market Clarity Act. Gratuitous distribution. In general, the term gratuitous distribution means a distribution of a network token, including a distribution effected by an agent or other service provider engaged solely in an administrative or ministerial capacity, in exchange for not more than a nominal value of cash, property, or services, or other assets in a broad, equitable, and non-discretionary manner, and includes without limitation the mechanism and methods of distribution described in subparagraph B. Mechanisms and methods of distribution. The mechanisms and methods of distribution described in this subparagraph are the following. Self-staking, the distribution of a unit of a network token as a pro- programmatic result of
You got it.
validating or staking activity for a distributed ledger system consensus mechanism, including the staking of a network token and the operation of a node, validator, or substantially similar software for such activity where the owner of the staked network token and the operator of the node, validator, or substantially similar software are the same person or entity. Self-custodial staking with a third party. The distribution of a unit of a network token as a programmatic result of a validating or staking activity for a distributed ledger system consensus mechanism, including the staking of a network token and the operation of a node, a validator, or substantially similar software for such activity in which the owner of the staked network token and operator of the node, the validator, or substantially similar software for such activity are different persons or entities, and the operator of the node or the validator or substantially similar software does not maintain custody or control of the staked network token. Liquid staking, the
Caveman,
distribution.
you got to stop talking to me like a lawyer. Talk to me in plain English here, brother. What the
In plain,
fuck are you saying? What does this?
okay,
What are we
in
talking
plain
about here?
English, in plain English, Section 102, which is ancillary assets. This creates a new category for many crypto tokens. In plain English, Congress is basically saying some crypto tokens may be tied to a company at first, but eventually become more like commodities than stocks. An example of this, an early startup token might act like a security. A mature decentralized token, maybe more like a Bitcoin or an Ethereum or an XRP, will be a commodity. It also forces projects to give disclosures, explain risks, reveal insider information, update investors regularly. Section 103 is the regulation crypto. It creates an easier way for crypto companies to raise money. In plain English, instead of you must become fully regulated public company immediately, this now says that crypto startups can raise money under lighter rules first. Think startup friendly fundraising, but still with disclosure and limits.
How important?
Section one,
How important is that section to protecting consumers in terms of the fundraising?
so I don't think you can be protected there. If I'm, but this is, I don't want to go into like my thoughts. What I mean by that is having been around startups and fundraising, you don't know if it's going to succeed. So you just don't. So it'll be no different in crypto.
Well, there is a limitation, right? We have $200 million.
That's
I
true.
think to some degree it does protect consumers because it's preventing these projects from endlessly raising massive amounts of money from retail investors with little oversight to it.
Yeah, because I mean, at the end of the day, this could just be a really great idea, but it doesn't go anywhere. Bad
Well,
management, bad
real
use
you
case.
right? I mean, it makes sense because real utility projects should be able to survive without constantly relying on retail for the fundraising.
Sure. I mean, you're capped at 200 million, right? I think there's also a provision in there like $50 million is what you can generate max, I think. Correct me if I'm wrong.
50 million per calendar year for 4 years, or 10% of the total dollar value for the assets that are outstanding.
Okay. What do you think, we will? You're on mute, but you can keep talking if you like.
Can you hear me now?
I can.
Okay. So where does it protect retail? So it forces disclosure. It's got annual reporting requirements. Anti-fraud rules supply. Anti-fraud rules still apply. It stops rug pulling via legal loopholes. And there's insider lockups. So team can't dump on retail in one day. So that's good for us.
Well, he was
So,
referring to the fundraising first, though. That's what he.
oh, okay.
And
Is
for the
that
fundraising only, you can't. There's
okay?
nothing you can do. It's. But
Okay.
yes, you what everything you just said.
So
I'm gonna read in a second.
as
You're
far as
absolutely
what the
right.
bill is kind of moving towards or protecting or so, but then it says it weakens where it weakens protection. Lighter than full securities regulation. So it's not an S-1. It's not a prospectus. Disclosure is real but thinner than with stock IPOs when they're required. So once it guarantees to community, the SEC is out. So CFTC has 700 staff versus SEC's 4,500. So less cops to beat you up.
So
The
let me.
CFTC has, okay, go ahead.
You're kind of jumping ahead.
Oh,
Can
okay,
we
okay.
can we go back
Go
to
on.
104? I'll finish
Absolutely.
the title of 101 and then we can go to title two. So for
Oh,
section
I need
104, insider dumping rules, which is what we was just talking about. It limits how
sorry,
much
guys.
insiders can sell. You're absolutely right. In plain English, this is founders can't suddenly dump on huge bags on retail investors. Good luck, DeFi. It tries to reduce.
Centralized control. Hi, we was kid. Very important for projects, many projects. And section 106 to 110, it says modernizes security rules for blockchain. In plain English, the government is basically saying, okay, blockchains exist now, but we need modern rules. This includes blockchain record keeping, insider trading laws, and custody rules and modernized regulation. Title 2, which is stopping criminal activity. Oh, my favorite. Who wants to do criminal activity? Title 2. Hello? Is anybody there?
So treatment of investor contact assets, is that what we're on? Title two,
So Title 2,
offers and
stopping
sales?
criminal activity. Yeah, exactly.
Okay. Sorry, I have a different layout than you guys, so,
No worries.
all right. Oh, boy. Do
What
you want me to
section is
read-
this?
Title 2. On that guy, it is page 121, bottom.
Okay. You want me to read the whole thing or?
I think we're gonna do it in layman's terms. I think
Okay.
Bully just told me that.
The chat is like, what are you even saying?
Before we jump into that, in Title 1, they discuss distributed digital networks, and I think that that's kind of important for us to actually talk about because there is a big number that's tied into here, which is 49% of the total amount. And this is kind of ensuring that we do have true decentralization, but they're able to measure that, right? They're able to hold them accountable. So the bill is essentially kind of saying here that like if you have a company or an insider group that controls more than 49% of the tokens or the governance power, then they're going to classify that as centrally controlled, right? It's gonna be classified as centralized. So they're kind of holding them accountable. And you may be able to say, oh, it's decentralized because we have nodes and validators all over the world, but now they're actually talking about governance and token distribution, right? And they say 49% here. I think that these regulations, it seems as if they're really cracking down on the decentralization aspect to it. It's not just DeFi, it's not just the governance aspect to it, but they're looking at the networks and, they are looking at the technology, but they're also paying attention to the distribution and the actual governance of the entities that are kind of pushing along the projects as well.
And so for me, decentralization is two parts, right? So the system is decentralized, how the system works, how it functions, does it need people to run? And then there's another layer of DeFi for us, right? Us people. Can we move money by ourselves? Are we decentralized? the decentralized piece that I think is going to go away with the bills like this is the decentralized piece for us. You know, the exchanges that don't require KYC or, you know, that type of stuff out the window. We are not going to be decentralized anymore, but these companies are decentralized. Yeah.
So what happens to projects? I'm not trying to throw any fun. This is a question I just thought of when you said that. What happens to projects that have an unlimited market cap that just burn and mint, burn and mint, burn and mint? By definition,
Market cap?
like, and by like, so like you, so okay, I'll just say it. Canton was the one that came to mind right away. Does that mean they would automatically be a security? Because we can't, there is no 51%. It's always, they can burn and mint whatever is being used, whatever is needed by what's happening.
Well, yeah. I mean, if you're looking at an entity according to this language that has more than 49% of the tokens or the governance power, then they're going to claim that as a centralized entity. And from the definitions that we read above with ancillary asset and everything that else is tying into, now we're getting a little bit deeper into how these systems are actually functioning and what entities are controlling it and how much power they have. Yeah, ultimately they could be classified as a security. Now for something that has an unlimited token supply, I think is what you're saying. And let's say that they're minting new tokens. Ultimately, I think it comes down to what is on their balance sheets. What are they reporting? So you may be able to have new tokens that are being unlocked and brought onto the market, but ultimately, if they're holding more than a certain majority of that, then that entity is centralized to the network. Therefore, they're going to look at that particular asset and say it's probably going to be classified as a security.
Yeah, so that was the fourth part of the Howey test, right? Like that's what's going to switch. Are they truly decentralized? If they're centralized, they're going to be considered a security, and if they're considered decentralized, truly decentralized, they will be deemed a commodity.
All right, let's get into 201. Unless you have anything else you guys want to add to that.
Oh shoot, no. I gotta get back to
No, what did you say? This was on page, I'm sorry, page 109?
121.
Okay, thank you. Go ahead.
All right, so I'll jump on this one in layman's terms.
Layman's.
My terms. All right, so Title II, what does it actually do? So it solidifies ancillary asset framework from Section 102 into SEC's rulebook. It caps SEC's jurisdiction. So once a token guarantee is via mature blockchain test, the SEC steps back and the CFTC takes over. Okay, so jurisdiction split. It creates a regulation path built for crypto, not the 1933 Act onto crypto. It ends regulation by enforcement, so no more Gensler style will sue you and tell you the rules in court, so they'll know what to do. It offers and sales of investment contract assets. Token sales tied to investment contracts must be registered or qualify as an exemption. New crypto specific exemption tier, so lighter than Reg A's but heavier than nothing. That was section 201. Do you want me to keep going into 202?
Yeah, we'll add anything if we have anything more to add.
Okay. So disclosure requirements, it requires filing, tokenomics, team holding, vesting, lockups, network architecture, and risk factors. Annual updates until assets generates in a plain English summary, not a 200-page document. Section 203 exemptions, small offerings under threshold dollar amount getting streamlined treatment, airdrops to existing holders get carve out, not deemed a sale. Already mature networks like Bitcoin, Ethereum style exempt from registration entirely. Section 204, Anti-Fraud Authority. The SEC keeps permanent anti-fraud jurisdiction over the original sale. Even after a token guarantees or graduates to a commodity, the SEC can still sue for fraud or initial offerings. So it's very similar to how the setup is for the stock market. Section 205, the mature blockchain test. The graduation exam, 20% supply, voting threshold, decentralization, open source, and functional network. So that's the blockchain test. 20% supply. Okay. Passing it, no longer a security. They move to the CFTC oversight. Issuer self-certifies. The SEC has 60 days to object. So there's a time frame on, it's not forever anymore, right? So the Section 206 custody rules, broker-dealers can finally custody crypto without an SBA 121 nightmare. And blockchain gets a path to crypto custody. It ties into Title V banking provisions. So let's see, Title II is the section that ends the SEC war on crypto. It tells the SEC, here's your lane, stay in it, but also tells the industry, you don't get to skip disclosure just because you call it a token. This is where XRP, Solana, ADA, they get their formal legal structure.
Wait, I'm sorry. You said Title II is where they're separating the SEC and the CFTC?
Yeah, so Title II is the jurisdiction, right? So who gets what?
Protecting against illicit finance?
Am I in the wrong section? Title II? The key, yeah, Title II. Sorry, let's see. Title II, where was it specifically? Title II, 206 custody rules.
206.
This is custody.
Title II offerings 206. Effective date.
They even address kiosks, your Bitcoin
Yeah,
kiosks in 7-Eleven.
Yeah.
Which is good. I mean, how many people have been scammed by those, right?
The effective date.
Did you
Okay,
find
yeah.
it?
Yeah, it looks like, so let's see.
206, the study on illicit use of digital assets.
I'm on the actual website. I'm not sure. Ours looks a little bit different because Title II, Section 206, the effective date is what I have. Is that what you have?
No.
So I think the link that you guys had was on X and I don't have that. So I just went to the website and went to Title II, Section 206. So maybe I will not read from this because I feel like we're on different.
Glassmaster says first draft, maybe, that you're reading. Possibly. I'm not sure. For Section 2, what I have, just so you know, so I have Section 201. It treats exchanges and brokers like banks for AML purposes. Basically, crypto companies now need KYC, AML, customer verification, suspicious activity monitoring. Basically, crypto businesses now act more like regulated financial institutions. Section 203 is government and private sector cooperation. Banks, exchanges, and law enforcement can share fraud info and they can track illicit finance together. Section 205 was what Bully was just talking about. The scam Bitcoin ATMs, the elderly fraud, anonymous cash abuse. They also add on things like transaction limits and customer support is needed, and so we can have fraud protections.
Yeah, essentially, my understanding of Title II was essentially saying that if you are going to become a part of this financial system, then these fintechs, they can't operate outside of the financial crime rules, right? The government they're really trying to crack down on blockchain DLT and crypto for money laundering and terrorism financing and fraud and sanction evasion. You look like you got something to say.
Accountability.
Accountability.
You can't just sell this shit and not have any like recourse.
Whether you like it or not, right?
We need to be able to pick up the phone and say, hey guys, like what is going on here? This is what's happening to me. Help me. That's what it's saying. Right?
And you know what? Like, as much as it is to kind of target the criminals, it's also a big reason why institutions have been cautious around this space for years, because these institutions, they're not going to adopt a system that the regulators think that there is like illicit activities or that this technology is enabling criminal activity. So like you hear David Schwartz say all the time, well, we're kind of nervous of terrorism funding on, you know what I'm saying? So there is a lot of large institutions out there that have been cautious to adopt simply because they're afraid the regulators will come after them from this illicit finance.
All right, want to read Title III?
So I think ours are different because you guys, you'll have to go ahead with it. But this is the right one because it's the right date. So I don't know. I'm sorry, guys.
Okay.
I'll listen.
All good.
You're very smart, so you can just...
I'll take it all in.
No, or challenge it.
Caveman?
Go ahead, buddy. You want me to?
Yeah, so Title III is response, innovation in decentralized finance. So this is kind of where the bill really starts to focus on the market structure. They're looking at exchanges, the intermediaries, the trading rules, and they're really kind of more focusing on how the digital assets are going to operate inside of the system. So they kind of, you have, when you look at centralized exchanges and decentralized exchanges, these exchanges are kind of operating within different rules, right? And a lot of these tokens are going to have different classifications: security, ancillary asset, digital commodity. So until they address this, we had uncertainty in this market for the custodying and the trading, the actual utilization of these assets in this ecosystem. So now they're trying to just create more of a framework for the actual assets themselves. And this is kind of where we're getting that oversight, right? So there's going to be more oversight for your exchanges, your brokers, the FinCENs, right? Your financial FinCEN, fintechs. You can also probably tie this into like how they're going to protect the individuals, right? They're paying attention to fraud and manipulation. So the regulators are trying to mature the actual digital assets themselves instead of leaving them completely unstructured in this title.
So one thing I did, the one thing that Section 304, which was about the offshore stablecoin monitoring. The U.S. is basically saying if offshore stablecoins become huge and dollar linked, we want oversight. Something I think that is pretty. It's geofencing, right? Like we're going to protect our borders and our economy. So,
but this title is something that we have been saying for years, right? The long-term winners in this space are going to be the ecosystems that can survive regulation and actually be able to be integrated into this infrastructure. This is that confirmation of that thesis, right? And a lot of Utility Unlocked, like when we dive into some of these projects, we are looking at whether or not they have real utility for interoperability or settlement. And compliance is really important, right? If these digital assets are going to be integrated into the financial system, then they need to have a type of market infrastructure that the institutions can actually participate in. And that's why this title is so important for us. It's almost a confirmation to what we share as a thesis, that some projects are going to survive long term and some of them won't, depending on whether or not they can actually operate inside of compliant market structures like this.
Guys, I have a question for you. There is a section here that could maybe potentially piss a lot of people off. Section 305. You want to scroll to that for a second? And that's page 171. Or for we will, it could be.
What is it called? What is it
It's
called?
called temporary hold for certain digital asset transactions.
Okay.
For everybody who's listening, if transactions look hacked, stolen, terrorist related, fraudulent, providers can pause it temporarily without getting sued. How do we feel about that? I mean, this is a general question for everybody, including obviously my two hosts.
I have been screaming this for a minute. Like when I do my one-on-ones with people, I tell them to make sure they buy their crypto from a legitimate place. Stay away from DeFi, stay away from wallet to wallet, unless you know exactly where it's coming from, because the whitelisting, there's going to be blacklisting as well, right? Like it's going to be regulated. So yeah.
I think it really kind of just depends on your perspective of this market, right? If you're one of those crypto guys that you want like a complete permissionless system forever with no intervention, then you're not going to like this at all. But if you're one of those investors that have like a clearer oversight that we are moving into institutional adoption and programmable finance and a tokenized future, then it only made sense, right? Because we have to, if you want this technology to start to be integrated into the global financial system, they have to follow the same rules as banks and all of these other payment processors, because this is law. These are the rules that traditional finance has to participate in. So if you want this technology to be treated as such, they have to be able to be held to that same standard. So it depends on the type of investor you are.
Okay, so I know what you're saying, and I do agree with you, but like again, just to like play the other side for a second. In the real world, up until like let's say tomorrow, if I have this pouch of gold or this bag of actual hard cash, I can do whatever I want with this cash. You're not going to take it from me, or good luck if you're going to try.
Until you try to get on an airplane.
Fair. But now it's kind of opening up the door to like, we have the ability to do whatever we want if we think
that's where it's going.
I agree, which is why I'm talking about this, which is why I'm literally bringing up, this is one part of the section 305 is one part where people are going to be like, I don't know.
Why do you think that it's wrong that they want these safeguards and risk controls for this type of?
I think so. You know the saying, "Power corrupts, absolute power corrupts absolutely." We're giving them absolute power right now over the things that matter.
So are you asking where are we? Oh, okay. So there's two different things for me happening in this conversation. So if it were to stop at what we're talking about right now, I would be okay with it. But knowing and understanding what's being implemented and what is going to be okay right now and where that okay is going to lead, it's not okay. So like this is digital programmable money. Understand that this money can be programmed to expire. It can be programmed to be frozen. It can be programmed to have limits as far as where you can spend it. You can only spend your money 20 miles from your house. Like the programmable side to this money is absolutely insane. When you dive down that rabbit hole and you read the agendas and the papers and you understand like, wow, they're really implementing this. This is the ultimate end game control. So when I started talking to you about, our fiat, our dollar bills, our money being turned into digital stable coins. Like one night you guys are going to go to bed, right? And you're going to be like, yeah, I have $470 in my bank account, and that's in money, right? You're going to wake up and that's going to be turned into a digital money. And most people won't even know, right? Because it's already banking, it's already digital. They don't hold that money yet. So when you start to see the dollar, the physical dollar going away, what are you going to do? Like, it's going to a digital programmable world.
I agree with you guys, and I think we all kind of have that same concern in terms of the programmable part to it. But I mean, this particular section is not addressed for that, right? They're looking at things for like the fraud or countries that are avoiding the sanctions, right? So it's certain suspicious financial behavior, I guess, is what you could say.
Terrorist related. It's a very
Sure, right, but it's for particular transactions.
Well, of course, they're not going to word it in a document where the public can read it and say, hey, this is the end game and it's ultimate control. They're going to make it seem okay and acceptable. Hence the reason in this bill, it also talks about how they're not going to implement CBDCs. But what people are failing to understand is that they don't need to implement CBDCs when you have digital money, period.
Yes.
I like that. Let's put a pin in that one. And guys, the three of us are for it. So you can imagine.
Well, we have no choice, right? So I think all of us in this space, or us three specifically, can kind of see what's coming, but can we get ahead of it? And can we put ourselves in a position to be ahead of it, to educate people so they can be ahead of it? That was my goal from the beginning when I started creating crypto content. Mm-hmm. It was to try and help people get ahead of the curve, but I don't vote for where we're going. I don't vote for ultimate control. I don't vote for my dollar. You can burn it, like it doesn't matter anymore. I'm not okay with that kind of control, but what are we going to do to stop it? So whether we think we have a vote or they have a vote or whoever has a vote, nobody really has a vote. They already know what's happening. They already know where it's going,
Yeah. I mean, unfortunately, yes, I agree.
Like, as much as I love crypto and the good that crypto and blockchain could do, it can do equally bad, if not worse.
Okay. We're going out a little bit off topic here. I agree with you, though, 100%.
So you know what
I'm going to pull you back in.
I'm going to get a little tinfoil hat, and when I'm going down the rabbit holes, I'm going to put that on.
A little tinfoil is okay. Title 4, Banks and Crypto. Presumably, I'm going to read this, right? Okay. So basically, traditional banks can participate in crypto. That's what this whole entire section is about. Section 401, banks can use blockchains and digital assets. Banks are officially allowed to custody crypto, use blockchain, process digital assets, offer crypto services, as long as they're allowed to do similar financial activities. I think for us, three of us, we would be like, 2 thumbs up. We want the banks. We want their money in here. Again, we can't tell you that it's a guaranteed home run, but we need these financial institutions in play. That's how trillions and quadrillions come on chain. If they're not here, it's going to be a casino for the rest of our lives. Section 404, no stablecoin interest.
Before we jump over to 404, can we maybe focus on this 401?
Absolutely.
Permissibility of digital asset activities. Mm-hmm. So we authorize activities for national banks. So I have a note here. It says banks are being prepared to participate in this future. And this is kind of the part where it's basically saying that the banks are allowed to use digital assets and blockchain infrastructure inside of the activities that they're already using. So now this is kind of the language that's enabling the banks to have and participate with the digital assets and the blockchain systems. So this is kind of where you start to see the banks and blockchains come together in this part, and it's no longer like crypto versus banks. And this is what we've been saying all along, right? If we want this technology to operate on a global scale, then we have to allow the banks to operate inside of the digital asset environments. And more often than not, the projects or the infrastructures that are enabling the banks to ease their day-to-day operations are going to be the ones that are important long term. But this is the section that is actually giving permission for banks to integrate in and operate on the blockchain and with digital assets. Go ahead.
Absolutely agree. I'm just making sure that I was just reading the federal the credit unions and all that stuff. Okay. You want to say anything about that?
No.
Okay. Section 404. This is the part that you want to, hold on to your diaper for. Basically, stablecoin companies cannot. Let me repeat this. Stablecoin companies, as it's currently written, cannot act like banks paying saving interest. Stablecoins could become, and the reason for that is in the eyes of the banks, stablecoins could become shadow banks. So no easy yield-bearing digital saving accounts, unless regulators approve special reward structures. Obviously, this directly impacts yield-bearing stablecoins and crypto saving products. And yes, this will definitely affect.
So yeah, this is the big conversation point, right?
This is the big one. This is the one that people. This is the one that people are talking about. You guys want to take the lead on this one?
We will swing at it. Yield on stablecoins.
Stablecoin yield.
Not prepared, guys, because I don't have the stuff up.
Okay, let me go back to what I had said at the beginning of the episode of this show. I don't think it was old news. I think that we kind of generally, when we were speaking, when everyone was speaking, we generally kind of thought, 1 to 2% was going to be the yields. Like that's what we kind of thought. We thought we were going to get something. Nothing, I don't think, was ever a factor that we were when we were discussing. When I was on these lives, I think most people felt something was going to be given. The reality is, back to stablecoin yields. The reality is that the stablecoin market cap right now is 323 billion at the max. 7 to 8% of people are in crypto. Let's assume it's 8%. And let's assume that all 8% are just pumping their bags and they're getting yield in stablecoins. That's what they're focused on. So that would be 700 million people. If 700 million people were making 8%, so which is 8%, sorry. If they were making yield, there would be $461 per person. So 700 million people, $461 each, which makes the 323 billion market cap, which is the highest it's ever been. They would generate an entire year last year, one whole year, they would make $16.40.
Did you say that's 8% though?
At 8%.
So it looks like.
No, I apologize. Not 8%. 8% of the people are in crypto.
Okay.
Which is 700 million.
Because it looks like it'd be 3 to 4% yield if
Correct.
they lose or whatever. Yeah.
Correct. So we're talking about $16.40, guys. That's not combating inflation. That's not going to help anybody, literally. Now, is that true for all people? Obviously not. I did a general, this is how many, I did a general average across the board. So when people are fighting this battle of no, we need our stablecoin. Well, I understand what you're saying, and I'm not saying you're wrong. What I'm saying is that there's a bigger pie that we're trying to go after. The reason the three of us are so we're proponents of moving forward with clarity and having a wave of institutional money come on chain is because I mean, this isn't my words. This is Broadridge's words. We're talking. We're talking like, what's the market cap right now of crypto? Somebody in chat, go ahead, tell me.
Maybe 1.2.
I would love to. I'd love to know. 2.7.
Is that what it is? Okay.
2.7. So 2.7. Excess of 30 is what people are thinking. Broadridge themselves said, based on the last month, a consensus that we're talking well over 30. Not a little bit over 30, well over 30. But that requires big money to come in. That requires us to have a stable infrastructure. That requires things to be in place in order for us to take advantage of that kind of money. Now, what is that going to look like? That you're absolutely right. That's the $1 trillion question.
Yeah, I mean, you're exactly hitting it on the head. There are definitely trade-offs for it, and you know what? For us to go from 2.7 to 30 to maybe 100 trillion at some point, in order for that capital to flow on these rails, stablecoins is a big conversation to it. And depending on how you want, like, what do you want a stablecoin to be? Do you want it to be a yield product, or do you want this to be actual payment infrastructure where they could be using stablecoins for settlement and liquidity and tokenized assets? Because if that's how you're going to view stablecoins, if you want the trillions of dollars to flow onto these rails, me personally, I would rather these stablecoins be used for liquidity and settlement and actually a part of payment infrastructure rather than a yield-bearing product. That's what I would want out of stablecoins. Now, I know that the banks take advantage of, the common man, and I completely understand that. But we have to have a real conversation of what do we want stablecoins to turn into. And for me, I want this market to go to 50 trillion. And stablecoins are a big proponent of that. I want stablecoins to be used for tokenized assets and for settlement. I want this to be payment infrastructure. So that's kind of the trade-off that we have to really kind of sit there and accept. What do you want? You want to earn your 4 or 5% on your USDC, or do you want this market to grow?
$10,000 in USDC right now would make you $350 this year.
So who here holds their money in stablecoins?
That's why I just gave you a generic number. $10,000 in USDC would make you $350.
Like, who's holding their money in $10,000 in stablecoins? Like, most of us, if we're using stablecoins, we're just in and out, right? Like, I don't hold it for very long. I mean, maybe a couple weeks if I'm waiting to do a trade, but like, so then right. So if you're right, 10K, if you're parking it in USDC for 1 year, you're getting $400 to inflation. So I guess there's a workaround though, guys. I didn't know this, but a workaround exists. You can move your tokenized MMFs to build or FOBXX and earn yield legally. Is that a thing?
It can't be passive. It has to be, you have to be doing something
Okay.
with it. So yes,
That's what working, but
it has to be working. It can't just be a savings account.
Okay. So it does matter for banks. For Circle and Tether, it matters massively. Circle made 1.7 billion in 2024 on reserve interest. Tether made 13 billion in 2004. That entire business model dies if they have to share with holders. Well, there's that. So it does kind of matter for the stablecoin holders, I guess, or companies.
The people who
issue the stablecoins.
Mm-hmm. Well, that's a
So
big part.
For the broader system, it matters. The ban is what keeps stablecoins as payment rail instead of shadow banking. Yield-bearing stablecoins, money equals funds without regulation. 2008 happened partially because unregulated shadow banking, and lifting the ban without new rules is systematic risk. So yeah, for the average people, I don't think it really matters. For the banks, it definitely matters.
we shouldn't say it doesn't matter because all money is good. You should be wanting to build your, but like the potential of the pie to grow bigger than we see now substantially increases if we have um, a I don't want to say a healthy law in place, but a starting point. A starting point that will allow institutions to come in.
Can we also address how if the stablecoin yield did stay in place, retail or the average consumer inevitably kind of shoots themselves in the foot? If you're talking about massive liquidations from your bank deposits to earn a yield on your stablecoins, the entire financial system runs on lending. So if you want an auto loan, if you want a mortgage, if you want a business loan, and there's less liquidity in the system, they're going to charge you a higher interest rate for that. So if you do want to participate in the system and use other people's money to obtain a house or whatever the case is, and trillions of dollars floods out of the banking system into stablecoins, okay, fine. You want your 4%, you want your 5% on your dollar. You're going to end up paying probably 2 to 3% more in your loans if you want to go to the bank and borrow money from them. That's a real conversation.
Yeah, everything will look like credit cards, bad ones. That's will happen. Because fractionalization is not going to be allowed, right? That's one of the things in this write up that is not allowed in crypto.
Wait. What isn't allowed?
Fractionalizational loans.
Oh, loans. So, but the tokenization is very fractional. That's the whole
Fractionalized. So actual, like, you have to be backed by dollar for dollar.
That's
You can't. Is it called hypothecate? Is that what it is?
Yes.
Yeah.
Section Title 5. Bill, you want to take it? Title 5 regulatory sandboxes.
This is so different than mine. I got innovation, technology, and improvements.
Responsible regulatory innovation is what the actual title is.
Yeah. So the Title V, responsible regulatory innovation, they're pretty much focusing on tokenization, securities that are being represented on the blockchain. And this is kind of them understanding that tokenization doesn't necessarily reflect in the same way that your traditional assets do, right? Your tokenized securities, in a sense, are, yes, they're the same assets, but they're going to respond differently than a tokenized assets because of the settlement rails that they're on. So we don't have a segregation of assets here, right? A stock is still a stock, a bond is still a bond, a security is still a security. But this is kind of them recognizing that this technology, in a sense, is not changing the ownership, but it's changing the way that they're representing, right? These assets are moving on to this infrastructure. So it is a very big aspect to it.
One thing I would just say, because I know this is something that we talk about a lot, Section 505 says that, and I just have a note here, if you tokenize stocks, bonds, or securities, they are still securities. So the actual definition of tokenizing these things are still securities and will be treated accordingly.
Yeah, they're not changing the asset itself. They're just changing the infrastructure of the asset, the way that the asset's actually going to transact on the rails.
So tokenization is all it is doing exactly what they do now, just they're tokenizing it on a ledger. So any security that's being tokenized, or any, how do you say, prospectus or IPO or anything like that, that whole framework isn't going to change. So of course it would be a security, right? The tokenization is tokenizing anything of value. And at this point, it's tokenizing people, businesses, or it's essentially creating capital for, companies. That's what the tokenization is, broken down essentially. So it would be a security. Does that make sense?
Yeah. I mean, like, putting something on chain doesn't mean you magically remove regulation. That's what we're saying. Like
No, no, it's the
still
same,
regulate.
exactly. Like you still, so actually, this is my company, guys, that I'm building. I'm building digital ledger markets, and I work with lawyers, and we structure people's company and tokenize it on the ledger. And it's still regulation D, regulation S, like these are still structured the same way. You do everything the exact same way for step one or layer one that you would for any of it. And then layer two would be the tokenization. So, Apex or a company similar to Apex tokenizes on the ledger. And then the next step, if depending on how it's structured, you would, have the broker, have it go live. But that's real world assets, that's golf courses, that's uh, my brain, anything of value, apartment buildings, Airbnbs. You can even tokenize a construction company, so anything of value that you want to raise capital for essentially is
God,
what.
I wish this was our normal show because I have so many questions for you. Like I actually have like a bombardment of a million questions. I guess the one that comes to mind right away, and I don't know if there's an answer for this from anybody. I think there's opinions and maybes, but so let's take away from what you're doing. So let's go Wendy's. Okay, Wendy's is on the stock market. I think I don't know if it is. But let's just say Wendy's is like trading during normal hours at like, call it $10 to make it easy. And then all of a sudden, for some weird reason, after hours,
So there's going to be no after hours. You can take that whole thing right out. So the tokenization is not going to run 7 to 4, whatever the stock market runs. This is going to be 24-hour
agreed.
running. So
Right. There's so many questions. We're gonna derail this completely.
We should definitely chat about it
We
sometime.
should definitely
I'm
talk
sure
about
that
this.
I will not be able to answer all of your questions, but the more questions you ask, the more solutions I'm going to have to find. So please, by all means, drop all the questions on me. DM me, guys, all your questions so that
the actual
He's
answer.
in there thinking about it.
Agentic AI. That's what it is. But I know that's the final answer. But yeah, I have so many questions for that. Anyways, legalities, all this fun stuff. Title 6.
I have to hop off for just a couple minutes because my kid.
Daddy, mommy. Okay, I'll go into Title 6. Are you okay with that, Willie? I'm not investing in Wendy's. Title 6, protecting developers. Title 6 for you guys following at home. Bully, what's the Title 6 say? Protecting software developers and software innovation. So obviously this is very important for DeFi or open source developers. Section 601, it's the developer protection section. This is I made a slight comment about the samurai guy developer who is currently in jail. This is literally what his wife is going to use if this gets passed to get her husband back home. So it protects coders from being treated like banks. Writing blockchain code alone should not automatically make you a money transmitter. Huge issue after Tornado Cash debates, DeFi developer fears. Section 604 is Blockchain Regulatory Certainty Act, and this is a big one. In plain English, guys, developers and validators are not automatically financial institutions. Otherwise, miners, they're miners, validators, node operators, could all accidentally become regulated banks. So this is not happening. Ray, fake weeboo just came into chat. Yeah, so that's 604. Do you want anything to 604?
Keep rolling.
Okay. 605, self-custody rights. It protects self-hosted wallets. In plain English, government agencies cannot simply ban MetaMask, Ledger wallets, or self-custody. People still have the right to hold their own crypto. Very important philosophically for crypto, and not just philosophically, but actual practical. And that would be the end of section 6 for me.
Yeah, and this is a really big aspect to it as well.
Yeah.
I mean, these developers or people that were building software, they were worried that they would be treated as criminals because somebody is using their code. So it's really important that we have the ability to kind of ease the worries, and in return, this is going to bring innovation onshore to the United States.
Yeah.
Really, yeah.
100%.
It really,
I mean,
it
the
really
very
is.
gangster days of everyone being chased out of town or a dodge, this will be ending now. This is good for development.
It's a big proponent to the future.
100%. Not to mention, did you see all the? I know like Money talks about this. Did you see all the job postings on like some of the major TradFi for crypto?
I did.
Okay.
Yeah, I did.
Interesting.
It's coming. It's coming. I don't know. Is AI coming for them?
I mean, a lot, yeah, for sure. Section 7, take it and run.
Run with it for a second. Let me grab it.
Okay. So section 7, guys, I have it written down as bankruptcy protections. In the actual act, it's protecting customer property. Have at her.
Yeah, so essentially this is kind of the part where they're saying, like, if these digital assets are going to be a part of the financial system, then they still have to participate in with a lot of the regulations that traditional finance has, right? So it's the anti-fraud protection and manipulation, things like that, AML, sanctions. So this is the legitimization of your blockchains, right? If they're being integrated into the banking system, into the tokenization, into settlements, then the regulators, they want the compliance, they want the oversight, and they want the safeguards, which is really important.
Yeah. I mean, your crypto should legally still belong to you. The whole FTX style bankruptcy, that goes away now. Moving forward, if this gets passed, so it's your crypto. It's not FTX's crypto. They're gone. I lost it all. It's yours. So you get protected.
And what's really cool about it is they are the regulators are stepping in, and they don't want these financial institutions in terms of the blockchain to be able to rehypothecate. Did I say that properly? Your assets, right? They want these safeguards to know that money is there, and we can actually put that onto the balance sheets, and they're not taking advantage of retail, which is really big, right? Your dollar is not turning into 10.
Yeah, agreed. Yeah, usury was banned for a reason back in the day. We just decided to be more clever than we should have been. Title 8. Which is customer education, unless you want to say anything else.
I don't have anything for this one.
Title 8, customer education. By the way, guys, shout out to the National Cryptocurrency Association. I met them both, Consensus and XRP. This is a non-for-profit entity that's sole mandate and purpose is to start educating the masses. Not you and me, not the 74 people who are here, the people who are going to be new to crypto. That's their whole goal. So National Cryptocurrency Association, go dive into them. They're great. Ali is a phenomenal person. Yeah. So that's the customer education. Only reason I brought that up. People, the reality is not the 73 of us that are here, 75, 76 with WeWoo, but the reality of the people, most of the people, they just don't understand crypto. Hell, I'm in crypto. Half the time I don't understand it. So how can we expect grandma to understand, right? Section 801 to 804, it requires disclosures, educational materials financial literacy programs, and bankruptcy explanations. Basically, exchanges and brokers must explain risks, scams, insolvency, how crypto differs from banks or stocks. And so that's more or less what Title 8 is about. It's just really about focusing and educating the newbies, and honestly, some of us probably need it too, to be honest, from the risks and also what's out there and what we need to be wary of, or what we can use to our benefit. So again, a very important part of this act so that we can have a safe transition for everybody, or as safe as possible.
Very good. Teach them.
Teach the masses.
Teach them.
Number 9.
What is that? That's XI?
IX.
Okay. So the Joint Advisory Committee of Digital Assets. This is your SEC, your CFTC coming together, and they're actually working together instead of fighting over the jurisdictions or the classification between these assets. So you're going to find the collaborations of the SEC, the CFTC, maybe the timelines for whatever they want to do with pilots or when they do want to implement rules. And this is, again, confirmation that we're moving away from the regulation by enforcement, and we're actually creating structured frameworks and coordination between the two entities, which is a big step, right? What do you have anything for the pilot programs that they mentioned?
Good question. Give me 2 seconds. The establishment program. The Secretary of the Treasury shall establish a pilot program under which covered agencies and designated private sector entities securely share information focused on potential illicit financial violations and threats. You don't mean that one, do you? Probably not. Established under subsection A. Nope. Requiring a teacher to participate in pilot program. An enabling director to select entity to participate in pilot program. Nope. Nope. Sunset. The pilot program established under subsection C. On the date 5 years after the date made permanent through notice and comment rulemaking by the Department of Treasury. Maybe this one. So I have here on page 129 the means of sharing information between agencies. Is that the way you're talking about?
No. I'm looking at the actual pilot program that they mentioned here. And this is kind of guiding them into the idea that there is going to be experiments, there's going to be pilots. And this is going to be through tokenization or CBDCs or settlement experiments. And then if you go down a little bit further, they do state, they do state a number here, right? Not later than 90 days after the date of this enactment, the director of the secretary shall designate 10 private sector entities that are money service businesses, 10 private sector entities that are digital commodity brokers, and 10 private sector entities that are banks to participate in the pilot program established under this subsection, if such entities agree and volunteer to participate in the program. So you have 10 private sectors that are money services, 10 of them that are digital commodity brokers, and 10 of them that are banks to participate in this pilot private. Do we have an inclination as to who these could be? Right? The director of the secretary is going to designate them. Who could be involved with this?
Can I ask you a question? What page is that on?
This is on page 127.
You know when you just accidentally go too fast? And you're like, oh, crap. Were you okay over there?
Taking it all in, wishing that I could bring up the X file because, according to Congress.com,
I mean, this is a SEC, CFTC sandbox. That's what they're telling us here. This is a sandbox where they're testing blockchain environments. So, who do you think could be involved in here?
Who do you think, Bully?
I don't know. I'll tell you what. It ain't gonna be what are those stupid meme coins? I can't even think of the names of the animal coins. It ain't gonna be them. I promise you that.
Dog with hat?
Dog with that. We both said the same one. Maybe we better buy some. Oh, Keevan, we better go get some dog with hat.
Right? I mean, just think of the projects you guys invest in, and what they have been involved with over the last 5 years. Are they looking at CBDC pilots? Are they exploring tokenization? Are they working with settlement? Are they working with interoperability?
All the above.
If that is the case, I mean, there's a good chance that they could be involved in this sandbox. But I don't even know if they would, if this would be public. And if that is the case, if let's say those 10 entities from each sector prove successful in what they are testing, does that kind of indicate that they could be tied to the government, or would it be tied to the government's finances?
I'm going to do what Farrell said.
What did Farrell say to do?
Break this down word for word and give us potential.
All right, so what you're asking what it is. It's 10 private sector entities that are money service businesses. All right? 10 private sector entities that are digital commodity brokers, digital commodity dealers, or digital commodity exchanges, and 10 private sectors that are banks. That's essentially who it is. Okay? So your banks could be involved in this. Your exchanges could be involved into this. Your digital commodity brokers, right? But you can also involve like your DeFi trading protocols in here as well, right? Any kind of blockchain innovation can also be involved in here. It's not. This is basically telling us that it's not just for Wall Street, right?
Okay, you ready?
Yeah.
Go with it.
Guys, I didn't read this, so I'm reading it just as you're reading, okay? The director and the security shall designate. In plain English, specific government officials will choose the participating companies. Usually this means Treasury, Commerce, financial regulators, or cybersecurity agencies, depending on the final version of the bill. 10 private sector entities that are money service businesses. That means that the government wants 10 payment, okay, Blue was just saying it, or money transfer companies involved. These are companies that move money, process payments, send remittances, provide fintech and payment infrastructure. Potential candidates?
XRP, XLM, fintech is XDC. What was
Potential
the other
candidates could include companies like PayPal, Block, Cash App, Stripe, Circle, Western Union, MoneyGram, Coinbase on the payment side, Ripple, Stronghold, MoonPay. This isn't me. Okay, just so we're clear.
XDC?
10 private sector entities that are digital commodity brokers, digital commodity dealers, or digital commodity exchanges. Now they want 10 crypto trading platform companies. This means exchanges, brokerages, market makers, crypto trading firms. Potential candidates, crypto brokers or exchanges. Likely candidates are Coinbase, Kraken, Gemini, Robinhood, FalconX, Jump Crypto, Anchorage Digital. No, Anchorage Digital was huge. Anyways, Bitstamp, Bullish, possibly Crypto.com, and Binance.us. 10 private sector entities that are banks. The government also wants traditional banks involved. This is very important. It means this program is not just for crypto native companies. The goal is likely to integrate crypto into the banking system, testing tokenization, payment rails, interoperability with traditional finance. Potential banks include, no surprise to anybody, JP Morgan, Bank of America, Citigroup, ironically, and Goldman Sachs, Wells Fargo, BNY Mellon, State Street Corporation, US Bancorp, PNC Financial Services, Customers Bank, Cross River Bank is a possibility, and Signature Bank, if operational historically. Signature Bank and Silvergate Bank. To participate in the pilot program, these companies are helping test the system before full national-wide rollout. Think beta testing for regulated crypto financial infrastructure. If such entities agree and volunteer to participate, I mean, if you're not going to volunteer to participate, then you really shouldn't be in this sector. I won't even bother reading that part. Biannual review. Every 6 months, the government will review the participants. Replace the private sector entities. In plain English, if some companies fail, refuse cooperation, underperform, they lose licenses, and this could obviously become very risky for their business. Big picture, the section is basically saying that the US government wants a controlled sandbox, basically what Bully just said, where banks, payment companies, and crypto firms work together under supervision to test the future financial system. I would say that they're already starting, but that's just my opinion. The very important signal here is crypto is increasingly being treated as financial infrastructure, not just speculation. Traditional banks are expected to participate alongside crypto firms.
You can't tell me that this is not so exciting.
I mean,
Everything that we focus on, interoperability, compliance, survivability, the settlement infrastructure, tokenization, all of these things, and we can look at other sandboxes, other proof of concepts, other pilots, the BIS projects, the Project Rosalind, Project Agora, any type of CBDC testing or whoever's looking at tokenized deposits. All of these are clear indications that they are looking for blockchains that have the infrastructure that are compliant, they're scalable, they are reliable. So look at some of these other projects that a lot of us have researched into: Rosalind, Agora, Nexus. Look at the global sandboxes, pilots, and proof of concepts. Everyone says proof of concepts is not guaranteed adoption, which is true, right? But look at the same names because they keep popping up over and over and over again. I would not be surprised if you look at some of the people that participated in those are going to be included into this.
I mean, I was in Consensus, and JP Morgan, Ondo, Ripple, who else did it? Who else did the whole? Oh, MasterCard, obviously. Did the first tokenized transfer. I'm like, guys, this isn't a maybe. Like, I mean, if you think by now that this isn't happening, I don't know what to tell you. There's
I've known this is happening for a long time.
but we didn't have verifiable data. The verifiable
Didn't
data.
though? I mean, like
Verifiable. Verifiable.
yeah, absolutely. Like I said, the BIS, the WEF, all these papers tell you they're building a new financial system. This is not the first paper.
Agreed. But now we're actually seeing the sandbox of the pilot, the puzzle pieces coming into place. See how I put the two together? Like the puzzle pieces. Come on, that was good.
You brought that on.
Yeah, it's gonna be really good actually. Well, I'm on the hunt for the money flow. I agree, Phil. 100% agree with that one. As am I. Now, so we started this with, do we know if we're actually going to be able to extract value from the projects that we're in? That's the $1 trillion question. I started that with that on purpose.
Value capture models, baby.
Value capture models. By the way, I'm fully aware that in our utility unlocked, I'm becoming the Alex of the three of us, and I hate it. but I am going to put fires under projects if I don't think that there's value capture.
I think it's kind of exciting.
But I think that you can assume and make assumptions on value capture, which obviously is what we all do. But in the end of things, we truly don't know how utility is going to capture the value. Yeah.
Yeah.
With any of them, though, if you think about it. I mean, even we just don't know. We don't know if, say, let's just use XRP, for example. We don't know if when everything goes live, that value capture, how that's even going to look. Is that going to be a $6 or, $20?
No, I know. I get it. I just, yeah. I'm not going to try to compare or change right now because that's not what this is about. But yeah, for me, I just want to know. Like, someone in chat earlier. Shout out to Chainlink for the news today. Was it today or yesterday? But like I know that companies have to get paid for the work that they're going to do. That's how companies survive. I don't know, and I'm not trying to poop on Chainlink here, but like, is there a value capture there for that token? I don't know that answer. I know that it's going to be used like crazy. I can totally see that happening. I don't know that answer. And so that's the question we have to always be asking ourselves. Don't just say, yes, it is, or no, it's not. Continually evolve with that.
JB Monty says, absolutely.
Sure. I hope so. I really do.
He says.
I now like also, I want to say Bermuda. Is that truth? Did you guys see the Bermuda news?
Mm-mm.
Full digital, full like the entire economy.
Are they fully digital? I'm gonna look into that. That's pretty great.
So, it's hard to be the crypto leader of the world if other countries continually exceed what we're doing right now. I include us meager Canadians in this conversation. Of course, it's a North American thing, but yeah. So okay. Question, guys. Bully, we will. You went through this Clarity Act, right? As it's currently. Oh shoot, we don't. You know what? No, we won't do that yet. Boys and girls, ladies and gentlemen, there's been some amendments. If you haven't read them, now is a perfect time. Can I just say I love that Warren woman? Like, I don't want to get in TikTok trouble again, but man, I love her. She's just such a good human being. 44. Okay, from the ones that did you get a chance to look at them? Housing, you want to touch on housing? Okay, what do you guys feel about the housing? Like, let's just add this housing section in. Concession? Bully doesn't want to talk about it.
I mean, yeah, this was something that was a big proponent of Warren, and I want to say, is it John Kennedy? Senator John Kennedy? Who else was a big proponent of the Build Now Act? It was Warren, and I might even have it on my phone. Yeah. Build Now Act was sponsored by Elizabeth Warren and John Kennedy in 2025. So a lot of people are a little upset because this is kind of like very unrelated to digital assets, and they're kind of like sneaking this in.
Did they sneak it in though?
Well, I mean, what
you shoot down your own bill. You shoot down this act, you shoot down yours as well.
No, something isn't lining up. There's a reason.
Oh, I know. If Elizabeth Warren is the proponent for this piece of this act, then it's you get all or you get nothing.
No, I think they absolutely snuck it in. And they typically always do. Almost in every bill, they sneak something in, don't they?
Explain that to me. Why do you think they snuck it in?
Because now they're kind of I believe that they said that it was inclusive because it does participate, like now that they have the was it the
See, there's more to
BSA.
it. So we should have broken down that bill before we took it out. So deploying the American Blockchain Act, the DABA, builds the infrastructure federal strategy for adopting tech inside itself. So let's see here. Commerce Department becomes a player. The DABA puts Commerce in charge of blockchain development strategy. The Clarity Act splits markets between the SEC and CFT. 3 federal agencies now have a lens: the SEC, the CFTC, and the Commerce infrastructure. It's never just sneaking a bill in, sneaking it over our heads, maybe.
I mean, they're literally talking about housing growth.
I'm with you,
The DABA pushes federal agency to adopt blockchain record supply chains identity. The DABA creates a blockchain deployment program that sets up best practices. Anti-offshoring agreement. Both bills share the same political pitch: keep crypto innovation inside the US. The DABA keep the tech here. Where they don't overlap, it doesn't define securities or commodities. So I think there's more to that than you're giving credit. I think they tie in more than people realize. I think now I've got to dive down that rabbit hole because that wasn't even on my list, to be honest. But there's never just a let's slide this in and see what happens. There's something more to it.
I think they typically do that in big bills. They typically do try to slide something that's completely, and maybe I'm wrong on it, but irrelevant to what the bill is. They're basically saying in this Build Now Act that if the housing supply and the development increases in particular areas, the government is going to give them allocations for that. That's basically what it's saying.
Yeah. Tell me how many construction companies they own it too. But that's not my point. My point is this.
So the steps.
I don't think they slipped it in.
They didn't slip it in.
Right.
So the
No.
Genius
Wait.
Act.
1 second. Let me just say what I want to say. I don't think they slipped it in. I think I knew if I wanted a bill, the actual real meat and potatoes passed, and I knew that bully was going to be a problem for me, a big problem, potentially ruin this. I would put in something that's really important to bully in this, so that now it's like, hey, you want that to pass? You got to pass it all. That's what I would do. That's why I don't think Warren and Haggerty and Tim Scott did any of this. I think I did it as a countermeasure to how they would react, because now you have them by the ball.
And I think that it plays in and it ties into this more, like, even I think it ties into blockchain more than people think.
Don't you think that's a little bit of a stretch? It's a little spreading thin to say that, okay, we're going to tokenize some of these assets, housing and mortgages and real estate. Sure, it could be on the blockchain, but what about the credit card companies? Did you guys read a single thing about credit cards in here? So, I mean, how thin do you want to say, yeah, blockchain is going to affect this? I mean, that could apply for people cutting down trees in the Pacific West. You know what I'm saying? Like, let's tokenize the logging industry, and I mean, gasoline, tokenize gasoline. I mean, there's certain, like, how thin do you want to stretch this? I think it's an appeasement to the lobbyists. That's what I think. I think they had an opportunity here, and they said, you know what, let's see if we can squeeze this in.
Yeah.
Elizabeth Warren. Let me just check something out here. Have I told you how much I love her? I think I'm going to call my next child Elizabeth.
can we look up to see how much money she received from donors for this?
Okay. Is it called DABA?
The Build Now Act.
Build Now. The Build Now Act.
Sorry, guys.
Bless you. No, bless you.
Kind of.
I got nothing.
Mm.
Can we call her?
I mean, they're literally giving federal money to communities if they're growing year over year and reducing money if those communities are not growing. Somehow we're going to connect this to clarity? Maybe I don't see it. I don't know. Is there a reason this is all the way at the end?
We're gonna check something else.
I mean, out of a 109-page document, this is on page 300.
So she's raised over $100 million. In 2024, she raised 18.5. In 2019, she raised 24.6.
What it sounds like is somebody has a friend that is developing communities and they want government funding, tax dollars, to go into those communities if we can prove that we are moving people here. Hey, this is what I'm doing. I'm a real estate developer, and I want this kind of embedded into law so I can receive federal dollars. That's what it sounds like. I don't know. Am I crazy?
I mean, I'm 100% with you on that one. But
okay, sorry.
The countermeasure is like, if you want that passed, you have to pass what I say as well. That's all.
Sorry.
How much is that worth to you? $55 million? Let's see it. Because that's apparently how much she raised last year. What a joke.
And
okay,
that's
so do we like anything else in these amendments, guys? Or hate, I should say? Was there anybody in there that you were like, oh, actually there was one guy who was trying to kibosh a bunch of crap. I was like, are you kidding me? Market transfer accounts, create digital assets. That's not it. Oh yeah. I found this interesting. Prevents a. Oh no, this is boring again. Forget it.
what are you guys' overall thoughts on the proposal?
Sorry, Bully, what was your question again?
What are your overall thoughts on the proposal?
I think it's pretty solid. I mean, other than the housing bill being tied into that, that's kind of BS, like leverage, I guess. But
I'm a little for my peoples who want. I think this is the beginning. I think it's a starting point. I don't think it's a good starting point. You know, in any negotiation, no side should be happy. And I don't know if both sides would be happy with this if it got passed. I know that a lot of the DeFi and the stablecoin side are definitely not happy. But then I'd ask you, like, why haven't we heard from Coinbase? Like, he was extremely against this in January, and now nothing, silence. So I would think that we know what we know, but I feel like we don't know the full picture. There's got to be something. There has to be a provision that's going to be in place that is allowing, Coinbase to stay silent. Like, there's no reason for him not to. What do you think?
I'm actually really proud that I caught this pilot program. I'm really excited for that.
Oh, it's a good one.
But I mean, overall, I think that this is what we have been. I mean, Caveman, you're an OG. I'm not sure how long you've been behind the camera teaching. For me, it's a little over a year, but this is what we talk about, right? Utility, interoperability, settlement tokenization, the actual infrastructure, assets that are going to survive based on compliance, and institutions actually integrating in with this technology. This is confirmation bias right here. This is everything that we need to prove our investment thesis. It's amazing that we were able to read it and go through it and test our investment thesis on it.
Yeah, I agree with that.
So can we just do one more if we're wrapping it up as far as this goes? Do you mind going to slide number 22?
That amazing slide you did. Well done.
I don't have the
feel like
numbers.
the
What's the name of
reason
the slide?
I don't think they care because they're going to be a bank anyway. As far as points go.
What is the name of the slide? I don't have the numbers.
What was I gonna say?
Oh, it's the bill. This bill is a framework, not a switch. And so the legislative path remaining. So I just want to make a quick note on this because on TikTok, I hear every day that as soon as this bill or tomorrow hits, clarity's coming and everything is going to moon tomorrow. So I just want to take a step back and look at this. Okay. So right now we're at phase number 1. This is tomorrow, May 14th, the markup and the vote. We still have 4 more base points to go. So it's not going to moon tomorrow. And then you see that you still got to go to the, reconcile with the Senate, all the things. So that can take time. So Bully, can you go to the next slide, please? So this is the timeline that you're looking at for this to come into play, right? So 270 days, that's the deadline. So you got 12 months to write the bill. Once it's signed by the president, you have 12 to 18 months before this becomes law. So understand that is all I'm saying. And then, so Clarity Framework is probably going to be fully operational from 2027 to 2028. So I just wanted to put my piece in there about that so that everybody understands and knows.
Thank you for that.
Just because all this is happening, which is super, super bullish and super exciting, it does not mean that it's going to moon even by the end of this year.
Well, damn.
Sorry, guys.
Just busted everyone's bubble.
Debbie Downer here, but let's be logical and let's be real.
All the people in DeFi land or like just Bitcoin maxis are gonna be like, see, we told you so. We told you nothing was gonna happen. Oh
yeah, they're gonna wait 4 hours after it's signed. They're gonna go, I told you.
It's true though, it's because everybody likes to say, I mean, I can't even scroll through TikTok anymore because I'm like, stop, please, just please stop. So that's the time frame that we're looking at.
We will to get back to something you said earlier about like when I was talking about value and you started talking about different projects. I do agree with you fundamentally 100%. And I equate it to like, you can always, it's so easy to look backwards at like things that were successful and be like, see, it worked. Like,
right.
See, Bitcoin worked. But like not Bitcoin, but Amazon, right? if you were early days in Amazon, I'm not saying that all of our projects are Amazon. That's not what I'm trying to say. But I'm just trying to think of like an investor's mentality that's forward thinking, that is looking at how the world is changing, adopting new technologies, and going forward with that investment thesis. You would never, a lot of these people in the crypto market would never have put $1 into Amazon ever. And if you fast forward to 2026 and you look at how many times, not to say that we stock split, but like if you look at where it's at now, if you had invested back then, this is sort of why the three of us came together. This is where to say that like, hey guys, you know what? We're not telling you you're going to get a Lamborghini tomorrow or next week or next year or 3 years from now or 15 years from now. What we're saying is that we have an opportunity to do well with an investment opportunity that we're never going to see again. You know, we have had opportunities in the past and we've missed those. This isn't one that we can miss. And we're here to tell you, the three of us are here to tell you that, hey, this is what utility could look like if adopted in the things we just talked about. And if that happens, damn, I'll be so freaking happy. I'll be like this. Where are my Bitcoin people at?
So
Come on, DeFi.
Right. So here's the thing too, like if we do see it, and people are going to say, Miss DC, you were wrong because it pumped and utility kicked in. So yeah. So as soon as this is passed, we're going to have retail FOMO, which is great. And we're going to see some price action from that. And that's wonderful. But what I'm talking about is not that. What I'm talking about retail won't touch what I'm talking about. They don't matter in what I'm talking about. So yes, just know that.
And very soon, this is all gonna be very boring because it'll all be in the back. The tracks will be laid, and everyone's gonna be like, "Yeah, crypto, whatever."
Grandma, how did you know? Because I was a nerd.
True. Who just who knows?
And that's okay. You're allowed to be a nerd. But like this is the conviction that a lot of people had back in the day for Bitcoin. That's all. I want to keep bringing that back, right? You did not know. You had a conviction. You saw something. You saw an opportunity. You saw a technology, and you said, "I want to do that." You didn't care about the people saying, "Idiot,